Good evening, everyone. Why don't we begin? Welcome to tonight's free Series 7 virtual review session. The purpose of tonight's session is to answer any questions you have about the Series 7 examination and also to go through some of the key relevant topics on the Series 7, some of the most challenging concepts, and some of the concepts that are heavily tested on the exam. The way tonight's program will work is we'll spend a couple minutes talking about the test itself and best strategies as far as preparing for the exam. After that, we'll go through some content. We'll take a break around 6:45 for a few minutes. If at any point you have a question, I would encourage you to type it into the chat screen. I do have everybody on mute just to eliminate any background noise, but if you have a question, you can type it into the chat screen, and I'll answer it at the next break or when appropriate, as it relates to the specific concept. My name is Brian Marks. I'm one of the partners here at Knopman Financial Training. Some of you, I believe, I've helped prepare for exams or have possibly been to my live classes. You have all of my contact information up here on the screen. If you have questions at any time, don't hesitate to contact me. You have my office phone number. You have my cell phone. You have my email address. I am responsive in the evenings and on the weekends when you're doing a lot of your studying. So again, don't hesitate to get in touch if you do have a question. For those of you who are just at the beginning stages of your prep, or you haven't had a chance to start your prep at all, or for those of you who have but maybe you're not aware of all this information, let's quickly run through the specifications of the Series 7 exam. This test itself is 2 sections and 3 hours long. Each section is 3 hours. Each section is 130 questions, which consists of 5 experimental questions and 125 graded questions. So in each section, you'll answer 130 questions. 5 of them won't count towards your score. You won't know which ones they are, though. In addition, each section of the exam gets more difficult towards the middle. So the first 25 will start out pretty easy. Next 25 will be a little harder. Middle 25 are going to be pretty tough. And then it gets easier at the end of each section. In between sections, you can take a break, as short as 30 minutes, as long as 1 hour. During the break, you can grab lunch, coffee, you can study if you'd like to. Second section, structure is identical to the first, 3 hours long, 130 questions, 125 of those questions are graded. When you're done with the test, you will submit your score. They will give you your score on the spot. The passing score is a 72%. So of the 250 graded questions, you need to correctly answer 180 to pass the examination. Okay. Before we move on to the first unit, let's talk about best study practices for the exam. The first thing you absolutely want to do is read the study material. This class is open to all students. Hopefully you are using our material, but if you're not, I encourage you to read whatever study material you have. Second thing I strongly encourage you to do is attend a class. We encourage you to attend one of our classes. If not, if you'd like to use our resources to complement another class you're attending or in lieu of a class, we have our full suite of lectures online. So we're going to go through about 90 minutes of content tonight. The actual online lectures are 13 or 14 hours of content to cover all of the information. And again, the purpose of the lectures is to pull out and distill the most important information to know for the test. Okay. Also, in addition, we have all these lectures available on a mobile app. Okay, so if you have an iPhone or an iPad, you spend a lot of time commuting or traveling on an airplane, you can download the lectures and watch them at your convenience. And we also have flashcards on that app as well, so you can use those to study. You'll find them very useful. If you'd like a description of our additional resources, you can feel free to get in touch at any point. In addition to reading the material and hopefully attending a class or receiving instruction of some sort, you're going to want to do practice tests. Generally, we recommend completing at least 1,000 practice questions before taking the examination, 1,000 practice questions. It's not uncommon for scores on the practice exams to begin in the mid-50s, so if you do your first couple exams, you score 50, 52, 55%, whatever, that's fine. That's fairly typical. Hopefully by the time you've done a few hundred and up towards 1,000 questions, you'll have scores in the high 60s and low 70s. Our practice questions generally are more difficult than the actual exam. So prior to taking the test, you want to be scoring consistently in the low 70s. If you're scoring consistently in the low 70s, that will generally provide you with some margin of error on the examination. In addition, make sure you follow up with us before you take your exam for any recent rule changes. For example, there's a new communications rule. The Jobs Act has had an impact on some of the rules that are tested on the Series 7 examination. So you should definitely follow up to ensure that you receive the most current information on the test. And finally, again, if you have any questions at any point, make sure you get in touch with us. If you have questions about a concept, if you have questions about study strategy, we're happy to chat with you on the phone for 10 or 15 minutes to talk about what you want to be doing to prepare. If you tell us, here's how much time I have, here's how much I work, here's my study time, we'll try to find you a study calendar that is customized and specific for your personal needs, both business and personal, so we can help you out there. With that, let's get going on the content. We're going to cover 4 topic areas tonight. We're going to cover, the first unit will be types of orders. The second unit will be a brief review of retirement plans. Third, we will discuss annuities. And the final unit we will discuss is options. We're going to start with types of orders. The focus here is on equity trading. And we're going to talk specifically about limit orders and stop orders, which historically are one of the more challenging concepts for people on the Series 7 examination. When a customer enters an order to buy or sell stock, the first thing that a registered rep will do is fill out an order ticket. That order ticket will include the customer's account number. It will include the specific transaction, if the customer is buying or selling or executing a short sale. With a short sale, the customer is selling the stock first, anticipating that it will fall. The name of the security, the quantity. Additional information on the order ticket includes the type of account, whether or not the trade is solicited, unsolicited, or discretionary. A solicited trade means it was recommended by the rep. An unsolicited trade means the customer calls the rep to enter the order. A discretionary trade means the rep has power of attorney and can make investment decisions and investment choices on behalf of the client. The order ticket will include the time the trade was entered, and it will include any price qualifications, which we will discuss now. If you find at any point, as an aside, that the pace is too fast, you can just use the feature to raise your hand. And if I see enough people raising their hands, that'll give me an indication to slow down, so you can just note that. The first type of order that you should know about is a market order. Okay. A market order is an order that guarantees execution, but it does not guarantee a price. It guarantees execution, but it does not guarantee a price. When a customer enters a market order, the order is filled at the best available price at that very time. And you have to be careful because this can be a little bit tricky. So a stock trading in the market will have a bid price and an offer price. The bid is the price at which somebody out there is willing to purchase the stock. And the ask, or the offer, is the price at which somebody will sell the stock. A customer who places a market order to buy, customer placing a market order to buy is basically saying the customer wants to buy the stock right now and does not care about the price they have to pay. They just want to buy the stock right now. So if the customer wants to buy the stock right now, what price would the customer need to pay? Well, the customer would need to pay the best offer, which in this case is $25.49. Customer would have to pay the best offer, which is $25.49. because the best offer is the lowest price at which an investor is willing to sell the stock. It's the cheapest price at which an investor is willing to sell the stock. On the other hand, a customer who wants to sell the stock at the market, a customer is basically saying, I want to sell the stock right now, and I don't care about the price. Well, they would have to sell the stock at whatever the current bid is, because that's basically the most that somebody's willing to pay. So a market order means the customer has to accept somebody else's price. In a market order, a customer has to accept somebody else's price. The customer is basically saying, I don't care about the price, I just want to get the trade done right now. Okay. Now, let's say a customer, though, does care about the price. Well, then that might be the customer who's bidding $25.42, saying, I don't want to pay more than $25.42. Or it might be the customer who's asking or offering $25.49, basically saying, I want to sell the stock for $25.49. When a customer specifies the price at which they're willing to trade, that's called a limit order. A limit order is a priced order. A limit order guarantees a price, but it does not guarantee execution. So a customer who says, buy Microsoft at $30 is basically saying the most they're willing to pay is $30. That's exactly the same thing as saying buy limit at 30. The tricky thing about limit orders is that all of you understand them, you just didn't know it's called a limit order. Okay. If you've ever negotiated to buy or sell a car, or to buy or sell a house, or you've negotiated to buy or sell something in a flea market, you place a limit order. If you've told somebody, I'll pay no more than $12,000 for this car, that's a limit order. You're saying, I'll pay no more than $12,000. It's no different than saying, buy limit at $12,000. Just an order where the customer has specified the worst price they will accept. And it's going to be executed at the first trade that satisfies the limit price. So as an example, continuing on the next page with the buy limit. So let's say a specific stock is trading for $50 a share. The customer wants to buy the stock, but the customer has decided $50 is too much to pay for it. The customer might decide, you know what? I'm not willing to pay more than $47.05. I'm not willing to pay more than $47.05. That's the same thing as saying buy limit at $47.05. The customer's saying, I'm willing to pay no more than $47.05. So as the stock trades down, you see a ticker of trades here. If the stock trades down to $49.05, will the customer pay $49.05? No, because the customer is willing to pay $47.05. Will the customer pay $48.35? No. Will the customer pay $47.65 or $47.10? Absolutely not. However, the customer would be willing to pay $47.05. So again, it'll be filled at the first price that satisfies the limit price. Okay, first price that satisfies the limit price or better. First price satisfying the limit price or better. On the other hand, let's say you have stock trading for 53 and a customer wants to sell it, but they're not willing to sell it for as little as 53. The customer might specify, you know what? The cheapest I'll sell this stock for is $56. Customer says I'll sell for no less than $56. That is identical to saying put on a sell limit at 56. That's identical to putting on a sell limit order at $56. Okay. So as the stock trades up, it hits $54.50. Well, you won't sell for that price because you'll only sell it for $56. It hits $55.25. You won't sell it there. It hits 55.90, it won't sell it there. But you know what? If you're willing to sell it for 56, certainly you'd be willing to sell it for 56.25. So the order would be executed at 56.25. So again, it's the first price that satisfies the limit price or better. First price that satisfies the limit price or better. Before we move on to the next type of order, let's talk about a circumstance. Let's assume an investor, forgetting about limit orders for a second and stop orders, but let's assume an investor has bought stock for $50. An investor who buys stock for $50 will want the stock to go up. But as an investor, you might be worried that it's going to fall, and you might decide, you know what, I'm only willing to lose $10 a share. You might decide if the stock goes below 40, forget it. I don't want to lose any more money. I'll cut bait. I'll cut my losses. And if it does, if it goes down more than $10, you might decide, you know what, get rid of the stock, sell the stock. When you make that decision mentally, basically saying, if it goes below this amount, cut my losses, I don't want to lose any more money, you just placed a stop order. That's a stop order. Again, you all understand stop orders. You just didn't know it's called a stop order. So a stop order is used to protect an existing position. You're basically saying, you know what, I own the stock at 50. If it goes down below 40, I don't want to lose any more money. Or you know what, I'm short the stock for 80. If it goes above 90, I want it to fall, but if it goes up, I don't want to lose more than $10. I'll close my position. You are protecting it. That's why it's called the stop loss, a stop loss order. You could also use it to create new positions, but we're going to focus primarily on stopping a loss. And if you think about what I said there, what I basically said was, if the stock goes down to this price, then sell it. Two things need to happen. First, you need it to hit that price or go through that price you specified. That's when the order is activated. Then, you're basically saying, then sell it. So that's when the order becomes a market order and is executed. So it's a two-step execution. You're saying, if it goes below 50, then sell it. Or if it goes below 40, then sell it. So if it hits the price, that's when it's triggered, activated, or elected, and then you're trading it at whatever best available price is in the market. As an example, a buy stop is going to be used to protect a short position. A buy stop will protect a short position. You're always protecting the opposite position. So to buy, you would buy to protect a short. So for an example, and again, just to remind you, an investor who sells stock short is speculating that the stock will fall. An investor who sells stock short is speculating that the stock will fall. So they're going to lose if it goes up, so they put a buy stop order above the market. As an example, let's say an investor sells stock short for 32 and puts on a buy stop at 35. Basically saying, you know what, if it hits 35, get out. If it hits 35, then buy it back. I don't want to lose any more money. So as the stock trades up, it hits 33.50. It hits $34.75. It hits $35. And once it hits 35 again, it's going to be activated, elected, or triggered. At that point, it becomes a market order, so which means you're saying buy it at the next available price, which in this case is $35.10. So that's where the order will be executed. So again, no matter what that price is, so if it's a little less, if it's $34.90, it's executed $34.90, but that's not so bad because you paid less. But let's say, for example, it hits 35 and is activated, and then the next price is 37. You could have a problem there because then you would end up paying $37, $2 more than you wanted. Okay, so you have some gap risk there given the two-step execution. A sell stop, on the other hand, protects a long position. So if you're long, you want the stock to go up. So if it goes down, you would want to sell it. So a sell stop would be placed below the market to protect a long position as the stock declines. It would be placed below the market to protect the long position as the stock declines. So for example, you have stock trading for 57. You might say, you know what, I'm pretty risk averse. I don't want to lose more than $3 a share. So you might put on a sell stop order at 54. Basically saying, if it trades below 54, then sell it. So as it moves down, I gave you a huge string of trades here. I'm not really sure why. You only need the first couple. But as it trades down, it hits 56. It hits 55.25. It hits 54.75. And then it goes through 54 and hits 53.90. Well, once it goes at or through the stop price, the order is said to be activated, elected, or triggered, and therefore it will be executed at the very next price, which in this case is 53.75. So no matter what that next price is, once the stop order is activated, it's going to be executed at the very next price, no matter what it is. So again, you were long the stock, and you said if it goes below this figure, get rid of it. And again, if you have any questions at any time, you can type them into the chat box. Now, another reason you can place a sell stop, remember I mentioned a stop order could also be used anticipating anticipating a big move. So a sell stop to open a new position, you can see here, it might be placed in anticipation of a breakthrough below a support level. So you can see a support level right here on the stock. A pretty obvious support level, right at 50. You can see every time the stock basically hits support, it bounces back off of it. But a technical analyst who makes predictions based on trading data would tell you that if it breaks below support, like you can see here below 50, that would be a bearish signal, and you would actually want to short the stock. So anticipating that might happen, you can see right now the stock is trading at 53. Anticipating that, you might put on, if you anticipate that that might happen, with the stock at 53 and a support level at 50, you might put on a sell stop at $50. Okay, so then as the stock trades down, it hits 52, it hits 51, it hits 50, but then a curious thing happens. At 50, all of these investors in the market have all put on sell stop orders because all of them see this very obvious support level. So as soon as it hits 50, everybody's a seller. As soon as it hits 50, everybody's a seller. Everybody wants to get out. So everybody tries to sell. What's that going to do to the stock? It's going to send it way down. It's going to send the stock tanking. So the next trade is at 47. So our trade was executed at 50, and we shorted the stock at 47. And here, you can see we kind of got screwed by that gap that I alluded to earlier. We wanted to sell the stock short of 50 to ride it down. By the time it actually, we are able to sell it short of 47, we've missed our opportunity. We knew the stock was going to fall, but by the time we short it, we missed our chance because it had already gone down 6%. So here you had an issue with that gap. Okay. So to give yourself some gap protection, what you might do instead of placing a stop order is you might place a stop limit order. A stop limit order is just like a stop order. Very, very similar to a stop order. You shouldn't think of it as being totally different than a stop order. It starts out just like a stop order. So if you put on a sell stop at 50 with a limit at 49, it starts out just like a stop order. So it hits 52, 51, it hits 50, and just like a stop order, it's going to be activated. The difference now is that once it's activated, that order becomes a limit order. Now you're thinking, oh wait, what's a limit order again? A limit order is a priced order. You're basically saying you want to sell it if it hits 50, but the worst possible price you will accept is 49. Rather than a traditional stop order, which says you'll accept any price once it's activated. So it hits 52, 51, then it hits 50 and it's activated. Now you're saying, all right, I'll sell it for 49. Well, if you're willing to sell it for 49, you won't sell it for 47, you won't sell it for 48, but you would sell it for 49. So again, it's activated, and then it will be executed at the best available price. The risk, what happens if it never gets back up to 49? Well, if 49 is never reached, the order is said to be activated but not executed. If it never gets back up to that price, the order is said to be activated but not executed. So if you're trying to protect a position, this is a little of a risky game. An investor who owns stock and says, I want to sell it for 40, but for no worse than 39.98, that's a risky game. You don't want to get too cute there, right? It could jump right over your range, and you end up holding the stock the whole way down. So that can be a little risky. Let's move on next to a discussion of retirement plans. And where I focus on retirement plans is going to be largely on the realm of the tax consequences of your various retirement plans, pre-tax or after-tax. I'm not going to focus on the contribution limits. I'm not going to focus on the acceptable investments. I'm not going to focus on when you can take money out, the 59.5 versus the 70.5. You can read about all that stuff in your material. Where I find that people have a difficult time with retirement plans is as it relates to figuring out if a plan is pre-tax or after-tax. So I'm going to talk about corporate plans, IRAs, and I'm going to talk about annuities. And I'm going to give you a chart, and if you memorize this chart, I think this will be extremely helpful for you to remember where each plan falls as far as the tax consequences are concerned. Okay, so we're going to start with corporate plans, and you'll forgive my rudimentary chart here. We're going to start with corporate plans, and corporate retirement plans can be either qualified plans or non-qualified plans. Okay, now, what does that term qualified mean? Very, very important term. Qualified means pre-tax contributions. Means pre-tax contributions. Means the money goes in before tax. They grow tax deferred. So all the dividends and income, you don't have to pay tax on it. But then when you take the money out, well, you haven't paid tax on anything yet. So when you take the money out, what do you have to pay tax on? You have to pay tax on the whole thing. Distributions from a qualified plan are fully taxed as ordinary income. Non-qualified plans, on the other hand, are after-tax contributions. So the money goes in after tax. So you pay taxes and you deposit the funds. So when you take the money out, what are you paying tax on? Only the growth. When you take money out, you are paying tax only on the growth. Now, what does it take for a plan to be qualified? Well, for a plan to be qualified, it must meet ERISA guidelines. It must meet ERISA guidelines. And I'm not going to go through the details of ERISA, but ERISA has a set of guidelines that retirement plans must follow. If it satisfies those guidelines, it's a qualified plan. Now, within qualified plans, you have two types. You have a defined benefit plan, and you have a defined contribution plan. A defined benefit plan is usually known as a pension plan. In a defined benefit plan, the retirement income is predetermined. An employee's retirement income is predetermined. And it's based on their age, their position, and their tenure, T-E-N-U-R-E, their tenure with the firm. Age, position, and tenure, how long they've been with the firm. So basically, the company would promise an employee, if you work with us till you're 60, we'll give you 50% of your salary for your first 5 years after retirement. Okay, that's a pension plan. It puts the burden on the employer. The employer has to come up with the funds. So therefore, it runs the risk of being underfunded. If the employer doesn't have enough money and has to go into debt, that's an underfunded plan. A defined contribution plan, on the other hand, well, that puts the burden on the employee. The retirement income depends on the performance of the plan. So you have a bunch of different types. You have a 401k. I'm not going to go through the details of these here. Again, my purpose is just to show you these different charts. You have a 401k, a profit-sharing plan, an employee stock ownership plan, a SEP IRA. That's basically favored by small businesses. And you have a KEO, which on the exam is also sometimes called an HR-10 plan. That's for self-employment income only. You may want to note that the maximum annual contribution to a defined contribution plan in 2013 is $51,000. Non-qualified plans, again, as a reminder, are after-tax contributions. So the money goes in after tax. So when you take the money out, what do you pay tax on? You pay tax only on the growth, only on the gains, only on the dividends, interest, capital gains, because you already paid tax on the principal. So you only pay tax on the growth. You have two types. You have a deferred compensation plan, and you have a payroll deduction plan. I wouldn't worry too much about the details of these for the exam. The key thing is just to recognize them. So again, whenever they refer to one of these plans, you want to picture, is it a qualified plan or non-qualified plan? Again, qualified means pre-tax. Non-qualified is after tax. Now, IRAs, you can do the same thing. An IRA is an individual retirement account. An IRA can be either pre-tax or after tax. Same idea. Now, who can have a pre-tax or qualified IRA? Who can have a qualified IRA? Well, only someone who is ineligible for a qualified corporate plan. So if you work for a company that does not offer you a qualified corporate plan, like a 401k, for example, you can potentially have a qualified or pre-tax IRA. I say potentially because it still depends on somebody's income. But again, if you work for a company that does not offer you a qualified corporate plan, your IRA can potentially be pre-tax. Now, if you work for a company that offers you a 401k, and whether or not you use it doesn't matter. If you work for a company that offers you a 401k or some other type of pension plan or other type of defined contribution plan, you can have an IRA. It's just going to be after tax, though. The money's going to be funded with after-tax dollars. Maximum annual contribution, by the way, for 2013 to an IRA is $5,500. And I tell you that because those numbers are tested on the examination. Okay. Variable annuities can also be pre-tax or after tax. And the next unit we're going to talk about will be variable annuities, so we'll go through them in more detail. But again, a variable annuity, just like an IRA, just like a corporate plan, can be either qualified or non-qualified. What would make it qualified? someone who works for the public sector. A public sector employee can have a pre-tax or a qualified variable annuity. This is called a 403B plan. So this would be somebody who works for a public school, not just a public school teacher, but anybody who works for a public school or a public sector employee. This is a 403B, which is basically a qualified or pre-tax variable annuity. Be qualified or pre-tax variable annuity. Everyone else, if you don't work in the public sector, you can have a non-qualified or an after-tax plan. I haven't had any questions yet, but if you have a question, now would be a good time to type it into the chat. Again, for these retirement plans, the key thing you want to visualize is you want to memorize these charts. When they ask you about it, you want to know what the consequences are. And again, the other key thing, knowing qualified is pre-tax, non-qualified is after-tax. With that, we are about at the halfway point, so this is a good time to take a break for a few minutes. Actually, I'm sorry, one more slide. I forgot. I was a little out of order there. So there's one more category of plan. There's one more category of plan that's neither qualified nor non-qualified. It's its own category, and you have three of these. These are plans that allow after-tax contributions, but tax-free distributions. Again, that's tax-free distributions. So when you take the money out, you don't pay a dime of tax, including on the growth. And that's for Roth IRAs, Coverdell educational savings accounts, and Section 529 college savings plans. And Coverdell and 529 are used for education. Roth is used for retirement. But from a tax perspective, they're the same. After-tax funds going in, tax-free distributions coming out. Any questions? Okay, so with that, we will take a break for a couple minutes. I show 6:37, so we'll take a break for 8 minutes till 6:45, and then we will continue on. Okay, why don't we continue on? Again, if you can't hear me, let me know. Although I guess you wouldn't know that. I'll type something into the chat. Okay. We're going to talk about two more units tonight after that quick break. We only have 90 minutes, so I like to use the time well. And I like to hopefully leave some time at the end for questions if you have any. We're going to talk about two more units. We're going to talk about annuities, and then we'll talk about options. There are two types of annuities. There are fixed annuities and variable annuities. Fixed annuities are not securities. It's basically a contract. So all you have to know about fixed annuities for the exam is that they're not securities. Variable annuities are securities, and they are maintained by an insurance company in what's called a separate account. Okay. Separate here means separate from their general account where they run their insurance business. So you have a general account where you run your insurance business, and then you have a separate account which deals with variable annuities. And variable annuities are SEC registered products. They are SEC registered. They are securities, so therefore they're registered. And a variable annuity, we're going to talk about non-qualified, which again are your after-tax variable annuities. A non-qualified variable annuity begins with the accumulation period. The accumulation period is basically when an individual is contributing to their non-qualified plan. There's a question which I'll come back to in just 1 second. So during the accumulation period, individuals making contributions to their non-qualified variable annuity, that money is typically invested in mutual funds. The investments are typically mutual funds. And while making contributions, the individual will earn what are called accumulation units. Accumulation units is just a measure of the size of the portfolio. It's a measure of the amount of money that is in the account. Okay, so as an individual makes a contribution, the number of accumulation units will increase. If an individual were to die during the accumulation period, there is a death benefit. The death benefit is available only during the accumulation period. If an individual dies during the accumulation period, their beneficiary would receive at least all previous contributions. If an individual were to die during the accumulation period, their beneficiary would get back at least all previous contributions. Quickly repeating what I mentioned about variable annuities. Variable annuities are securities. They are maintained by an insurance company in a separate account, meaning separate from their general account where they operate their insurance business. So they are securities. They're maintained in a separate account, and because they're securities, they are also SEC registered. Since they're securities, they are SEC registered products. At some point, the account will be annuitized. So first you have the accumulation period, then you have the annuitization period. When the account is annuitized, that means that contributions will end and distributions will begin. Contributions will end and distributions will begin. And when the account is annuitized, the accumulation units become annuity units. An annuity unit is a measure of the amount of money in the portfolio. And you don't have to know how to calculate it. The key thing to know, one key thing to know here, is that the number of annuity units is fixed. The number of annuity units does not change. Now, what will change is the value per annuity unit. So here's basically what happens. When the account is annuitized, the annuitant will begin receiving monthly distributions. Those monthly distributions depend on the performance of the portfolio. And you have this thing called the AIR, the assumed interest rate. The AIR is the expected monthly performance of the portfolio. It's the expected monthly performance of the portfolio. Okay. So the way the monthly distributions works, you just want to jot this down. If the portfolio, if the actual portfolio outperforms the AIR, if the portfolio outperforms the AIR, the distribution will be greater than the previous month. If it outperforms the AIR, the distribution will be greater than the previous month. If it underperforms the AIR, so if the AIR is 6% and the annuity return is 4%, if it underperforms, the distribution will be less than the previous month. So if it overperforms, the distribution will go up. If it underperforms, the distribution will go down. If it's the same as if the performance equals the AIR, the distribution will be the same as the previous month. So you're comparing every month, you're comparing the actual performance of the portfolio versus the expected performance. Again, the expected performance being the AIR. And if the actual portfolio outperforms the AIR, the distribution goes up. If it underperforms, it goes down. If it performs the same, distribution will stay the same. Continuing on the next slide, the monthly cash flow also depends on the expected length of the annuity. So depending on for how long the insurance company selling the product expects to make payments for, that will impact the cash flow received by an annuitant. A straight life annuity will pay monthly distributions until the annuitant dies. It will pay distributions every month until death. So basically, that'll have the shortest expected life of these three options. So therefore, of these three choices, it will have the highest monthly cash flow. The shortest expected life and therefore the highest monthly cash flow. A life annuity with period certain will pay monthly distributions with a guaranteed minimum. And the guaranteed minimum is typically 10 years. The period certain is typically 10 years. What that means is that distributions will be paid for at least 10 years. So if the annuitant lives for 7 years and then dies, the beneficiary will receive money for 3 more years. If the annuitant lives for 12 years and then dies, the annuitant will receive money every year, but nothing more upon death. So it guarantees the distributions will be paid for at least 10 years. And then you have a joint and last survivor annuity, typically for a married couple. Joint and last survivor will pay distributions over the lifetime of 2 annuitants. It will pay distributions over the lifetime of 2 annuitants. Of these options, joint and last survivor will have the longest expected life. So therefore, it will pay the lowest monthly cash flow. Longest expected life, so therefore lowest monthly cash flow. If anyone has a question on this concept, on annuities, happy to answer it now. There's your general overview, though. Okay, now we'll spend about 20 or 25 minutes talking about options, and then I'll leave some time for questions. A couple general notes about options. Okay, options, you're likely to have about 30 options questions on the test. Most of the options questions on the exam focus on the basic strategies, such as buying a call, buying a put, selling a call, and selling a put. I know there's a tendency to really want to become an expert on the spreads, but you're not going to see as many questions. Sorry, hit mute there by mistake. I want to briefly discuss the documents required when opening an options account. Okay, and this information is fairly heavily tested on the exam. The first document is the OCC Options Disclosure Document. This is a risk disclosure document. It's a risk disclosure document. Okay, the OCC is the Options Clearing Corporation. The disclosure document must be given to a customer at the absolute latest upon account approval. Customer must receive the OCC disclosure document upon account approval. The second document that's required is the options agreement. Second document is the options agreement. In the options agreement, the customer confirms receipt of the disclosure document. So they're confirming that they received the first document and agrees to abide by position limits. So the customer confirms receipt of the disclosure document and agrees to abide by position limits, which we're not going to talk about here, but you can read about in your text. That options agreement must be signed by the customer within 15 days of account approval. It must be signed by the customer within 15 days of account approval. So the customer can do whatever they want for the first 15 days. If it is not signed within 15 days, until it is signed, the customer can only close existing positions. So you can do whatever you want for the first 15 days, but beginning on day 16, if you haven't signed it, you can only close existing positions as a customer. You cannot open any new positions if you haven't signed it within 15 days. Also, an options account must be approved. The third point down, it must be approved by the ROP, which is the Registered Options Principal. Must be approved by the Registered Options Principal, the ROP. So one thing to add here is this notion of a timeline. So they might ask you to rank these events in the order in which they occur in an options account. First thing that happens in an options account is that the customer receives the disclosure document. First, the customer receives the disclosure document. Second, the account will be approved. Third, the customer can begin trading. And fourth, the customer must sign the options agreement. So again, you can begin trading, and after that, you can sign the options agreement. Let's talk about the math, and let's talk about the details of a typical option. So anytime you get an options question on the exam, it's going to be written in a paragraph, and you're going to write it out just like this. That way you only have to look at the numbers. You don't have to read all the wordy jargon of the question. So we're going to buy 10XYZ, Jan 35 calls of 3. We are buying call options. We're purchasing calls. So we're buying, we own call options. 10 is the number of contracts. And a standard equity option contract represents 100 shares of stock. So this position represents 10 contracts times 100 shares per contract. So this position represents 10 contracts times 100 shares. So this position represents 1,000 shares of stock, 1,000 shares. XYZ is the stock in question, XYZ common stock. Okay. January is the expiration month. It's the expiration month. And you want to know that options expire on the Saturday following the third Friday of the month. They expire on the Saturday following the third Friday of the month. It's not the fourth Saturday. It's not the third Friday. It's the Saturday following the third Friday of the month. 35 is the strike price. It's the price at which a transaction will be executed if the option is exercised. And Jan 35, that's the series. That's the combination of the expiration and strike price. It's the combination of the expiration and strike. So if either of those is different, it's a different series. So if it were Feb 35 calls, that would be a different series. Feb 40 calls, that would be a different series. So if either the expiration is different or the strike price is different, it's a different series. Calls and puts refers to the class. So every stock has two classes, calls and puts. So IBM calls are a class. IBM puts are a class. Yahoo calls are a class. Google puts are a class. And call options represent the right to buy. So we're buying a call, which means we have the right to purchase XYZ stock. We have the right to purchase XYZ stock. And 3 is the premium. It's the cost of the contract on a per share basis. It's the cost of the contract per share. It's a market value of the option. So the total cost for this position is equal to $3 per share times 100 shares per contract times 10 contracts. So the total cost for this position is $3,000. So again, now you know all the nomenclature when you look at this position. And you absolutely want to write out every question like this when you see it for options. That way you know what you're looking at. Now let's talk about what happens when you buy a call option. When you buy an option, that's called an opening purchase. When you buy an option, that's called an opening purchase. When you buy an option, you can do one of three things with that option. First thing you can do is exercise the option. Second thing you can do is you can do nothing, and eventually the option will expire. And the third thing you can do, and this can be a little tricky, is you can trade the option or liquidate your position. It's important to remember that an option is a security, just like stock. An option is a security. So if you buy a call option and you don't want to own it anymore, you can go into the market and you can sell the option. Just like when you buy stock, if you don't want to own it anymore, you can sell it. So how do you do that? Well, if you have an opening purchase, so we bought the option for 3 in the previous example, on the previous slide, you could sell it. And you might profit or lose, but you could sell it. So we might sell it for 8 and make a profit. On the other hand, if you sell an option, if you have an opening sell, it's called writing an option, W-R-I-T-I-N-G. If you write an option and you want to close your position, just like closing a short, you go into the market and buy it back. You just do the opposite. You just do the opposite. And that's called a closing purchase. So again, you can basically trade the option. And most options traders will liquidate positions rather than exercising. So this third choice of liquidating the position is actually much more common in practice. Okay. All right, so let's talk about the math. So we're going to buy 2 ABC October 30 calls at 4. Whenever you see an options question, the most important thing to do, the very first step on an options question, is to figure out the attitude of the investor. Meaning, are you bullish or are you bearish? You have to figure out the attitude of the investor, bullish or bearish. Well, in this case, we're buying calls. Remember, calls represent the right to buy the stock. So we have the right to buy the stock for $30. The question is, when would you want to buy stock for $30? Would you want to buy stock for $30 if it was worth $20? No, you'd never buy stock for $30 if it was worth $20. How about if the stock is worth $50? If stock is worth $50, would you want to buy it for $30? Sure you would. So when you buy a call option, an investor who buys calls is bullish. An investor who buys call options wants the stock to go up, so that way the investor can buy the stock for less than it's actually worth. As an example, you can forget about this out of the money for 1 second. Let's say the stock is worth 20 bucks. If stock is worth 20 bucks, would an investor want to buy for 30? No, definitely not. So what would you do as an investor at this point in this situation? You would let the option expire. You wouldn't do anything. You would let the option expire, and if you let it expire, what's going to happen? Well, you're going to lose your $4 premium per share times 200 shares. How did I get to 200? Let's bring up my pen here. You have 2 contracts. Remember, each contract is worth 100 shares. So total of 2 contracts times 100 shares, 200 shares, so you lose 800 bucks. For a call option, very, very important, for a call option, when the market value is less than the strike price, the option is said to be out of the money. When the market value is less than the strike, the option is out of the money. Effectively, means you're going to let the option expire. If, on the other hand, the stock is worth $50, would you want to buy it for $30? Sure you would. Definitely want to buy stock for $30 if it's actually worth $50. So you exercise the option. There's a lot of stuff here, so let me walk you through it. You exercise the option. You buy the stock for 30, that's your strike up here. You sell it for 50. So you make, as a result, $20. The difference. You buy it for 30, you sell it for 50. So you make $20 on the exercise at 30 and the subsequent sale for 50. So you make $20 a share minus your $4 premium. Don't forget you paid $4 for the position. So you make $16 a share times 200 shares. So you make $3,200 of profit. You make $3,200 overall. And again, whenever the market value is greater than the strike price for a call option, whenever the market value is greater than the strike, the option is said to be in the money. And by the way, if the market value equals the strike price, the option is said to be at the money. The key thing on this slide, really, really important, fundamentally important concept to understand and learn options. If the market value, whenever the market value is, when an option is in the money, so a call is in the money when the market value is above the strike, what does that mean? It is a fact that the option will be exercised. So for a 30 call, it is a fact that if the stock is above 30, it's going to be in the money. That doesn't necessarily mean, though, that you're going to profit. So the key thing to know, in the money does not necessarily mean that the position will be profitable. Because you might be selling the option. You might be writing the option. You might be on the other side of the trade. So the fact that it's above 30, the fact that it's exercised, doesn't mean it's profitable. It just means it's exercised. And it's out of the money. If it's out of the money, if it's below the strike, that doesn't mean you're going to lose necessarily. If you wrote the option and it's out of the money, you profit. You get to keep your premium. But the point is, key thing for call option, if it's in the money, that means the market value is above the strike, and it's a fact that it's going to be exercised as far as we're concerned for the test. If the market value is below the strike, it's out of the money, it is a fact that the option will expire. Questions? I guess you can chat if you have them at any time. Continuing with the same position at the bottom of your page, we're buying 2 ABC October 30 calls. Again, first thing you want to do is figure out the attitude. What's our attitude? We're bullish. We decided that on the top slide. For any options question on the exam, they're going to ask you one of 3 things. The first thing they might ask you is, what is the maximum gain? What is the most amount of money we could make on this position? What is the maximum gain? And whenever they ask you this, real simple, make it real easy. Don't memorize anything. Just plug in a number. So if we're bullish, we want the stock to go up. So in which direction do we achieve the maximum gain? The stock goes up. So you make up a number. Let's say the stock goes all the way up to 100. You could plug in 200, 750, plug in 100. It makes the math nice and easy. And then you evaluate the position. So the market value of 100, we have the right to buy the stock for $30. Would you want to buy stock for 30 if it's actually worth 100? Sure you would. It's in the money. It's deep in the money. So we buy the stock for 30. It's worth 100. We make 70 bucks. Now we paid our $4 premium, but not really a big deal. So overall we make $66 a share. Now what happens if the stock keeps going up? Well, let's say the stock goes up to 150. Well, it's deep in the money, right? We have the right to buy the stock for 30. It's actually worth 150. So certainly we're going to exercise. We make the difference. We make a profit of $120. Don't forget we paid our $4 premium. So overall we're going to make $116 a share. So what's your maximum gain if you buy call options? Your maximum gain is unlimited. How about your maximum loss? So we want the stock to go up. So which direction are we going to lose? The stock goes down. So what do? Worst case scenario for us as it relates to the stock is the stock could fall all the way to 0. So you plug in 0. That's the worst thing that could happen. Again, it's not fancy, but this gets the job done. That's all we care about for this test. We don't care about, there's no style points on Series 7. At a market value of 0, is this option in the money or out of the money? It's out of the money. Again, a call option is out of the money whenever the market value is below the strike price. Why is it out of the money? Because you're not going to want to buy the stock for 30 if it's actually worth nothing. So it's out of the money. It expires. Then we just lose our premium. Again, when the option's out of the money, there's nothing to think about. It's just the premium that you have to deal with. And the break-even. They love to ask about break-even on the test. They love to ask you about break-even. Break-even is the market value where the profit or loss is exactly 0. It's the market value where the profit or loss is exactly 0. Well, we paid a $4 premium here. So how do we break even? Well, we got to profit $4. So therefore, the stock, we'd have to earn $4. What would have to happen for us to earn $4? Have to go up to 34. Now, how do you want to think about break-evens on the test? Real simple. Okay. Nothing fancy. You don't want to memorize formulas because when you get to more complex positions, I know some of you are thinking like strike price plus premium, strike price minus premium. That's all fine and well in single positions, but when you get to spreads, that's not going to work anymore, and you're going to get wrong answers. Just plug in your answer choices. So 2 of the choices on this question, I guarantee, let me just bring up my pen here. 2 of the answer choices on this question, I guarantee, will be 26 and 34. Because they know on the exam that if you don't know how to find break-even, you're just going to wildly add and subtract that $4. So you try them both. You say, all right, at 26, how do you do? Well, it's out of the money. The option expires, and you lose $4. And since you lost money there, therefore it is not your break-even point. On the other hand, at a market value of 34, well, what's the status of the option? Is it in the money or out of the money? It's in the money because you can buy for 30 and sell for 34. So therefore, you make $4 on the call. Well, you paid your $4 premium, so plus 4 minus 4, and there is your break-even because your profit or loss, you can see, was exactly 0. So just plug in your answer choices. This works every single time. It works for hedges. It works for spreads. It works for straddles. It works for covered positions. It works for single positions. For break-even, don't memorize. No fancy tricks. Just plug in your answer choices. You look for the one like I did that gave me 0. That's what you're doing. Okay. Now you'll see for hedges works the exact same way. A hedge means you have a stock and an option. So we're selling short 100 shares of ABC stock at 67. Remember, when you're selling short, we're speculating that it will fall. We're going to buy an October 70 call at 6. What's the first thing I said you do? First thing, you got to calculate the attitude of the investor. Again, bullish or bearish. Whenever you have a stock and an option, the attitude is always based on the stock position, which here is the first one. See, this first one is our equity position, and that determines our attitude. So if we sell stock short, we are bearish. You sell stock short, you're selling it now. You want it to fall so you can buy it back later at a cheaper price. We're bearish. So if I were to ask you your maximum gain, again, same song and dance. Oh, well, in this example, we'll plug in a market value. So let's say the stock goes down to 10. That's not necessarily your maximum gain because it could go all the way to 0. But just as an example, you're just evaluating your position. So they're going to tell you on the test, at a market value of 10, what's the customer's profit or loss? And here, you're always going to have a nice, organized, technical approach. What do I mean by that? I mean first position, second position, premium. First position, second position, premium. So the market value of 10, at a market value of 10, we sold the stock short. We sold the stock short at $67. Is that going to be good or bad? That's great, right? We sold the stock short for 67. Now we buy it back for 10. We make 57 bucks on the stock. Well, the option's out of the money. We're not going to want to buy the stock for 10 if it's worth 70. We're not going to want to buy the stock for 70 if it's actually only worth 10. So it's out of the money. It expires, and we paid our premium. So we make 57. We paid our $6 premium. So we'd profit $51 a share if the stock goes all the way down to $10. Let's say the stock goes up. Let's say the stock goes all the way up to 95. Again, first position, second position, premium. So the market value of 95, we sold the stock short at 67. Remember, when you sell stock short, you want it to go down, but you'll lose if it goes up. So we're going to lose on the stock. We're going to lose 28 bucks a share. The option is in the money because we have the right to buy the stock for 70. It's actually worth 95, so it's in the money. So we make 25 bucks on the call. We paid our $6 premium. You can see we lose 9 bucks a share. So again, you can see this is a good illustration of what I mentioned, that nice, organized technical approach. You see I did my first position, I did my second position, and then I did my premium. First position, second position, premium. Every time you have two options or two positions, here we have a stock and an option. Later we'll have an option and an option. First position, second position, premium. Nice, organized, technical approach every time. Nothing fancy. What if I want to find break even? Well, here again, how are you going to do it? You're just going to plug in your answer choices. What are going to be your answer choices here? Well, your answer choices, again, they know on the test that if you don't know, you're just going to wildly add and subtract. So what answer choices are going to give you? They're going to give you this $6 premium plus 67. So let's see if I can draw this out here. So one choice will be 73. That's 67 plus 6. Then you take 67 minus 6. So second choice will be 61. Third choice will be 70 plus 6, which will be 76. Fourth choice will be 70 minus 6, which will be 64. So again, they don't do you any favors because they know if you don't know, you're just going to take the 6 and add and subtract till you get something that works. But just plug in all the choices. And what you'll see here, I'm not going to go through it all here, but you can practice this on your own. What you can see here is basically you paid a $6 premium. You paid 6 bucks. So to break even, you got to make $6 back. And how are you going to make $6? Well, you're short the stock at 67. You sold it short at 67. You got to earn 6 bucks, and if you sell stock short, remember you want it to fall, so the stock would have to fall to 61. Again, for those of you memorizing call option break even is strike price plus premium, the break even is not 76 here, so that's where you have to be careful memorizing. Just plug in your answer choices. Nothing fancy. It's not cute, but nobody grades your work on this test. All they care about is that you pass. And you'll see here, by the way, how is this a hedge? How does this position serve as a hedge? What does it mean if it's a hedged position? Well, let's pretend for a second that we didn't have the option. Let's pretend we were only short the stock. Well, if we're only short the stock, what's our maximum loss? Well, it's unlimited. Because eventually we're going to have to buy it back. So if the stock goes to 95, we'll have to pay $95 for the stock. If the stock goes to 120, we'll have to pay $120 for the stock. If stock goes to 150, we'll have to pay $150 for the stock. So our maximum loss is unlimited. But when you bring this call option into play, what are you locking in here at 70? You're locking in a purchase price. So now, when the stock goes up to 95, we don't care because we can buy the stock for 70. When the stock goes up to 120, we do not care because we can buy the stock for 70. When the stock goes up to 150, we don't care because we can buy the stock for 70. So no matter what, we can buy the stock for 70. So we sold it short at 67. We'll never have to pay more than 70, so we'll never lose more than that $3 difference. Don't forget we paid our $6 premium. So that's why our maximum loss is going to be $9. So that's why it's a hedge. Because now, no matter how high the stock goes, it doesn't matter to us at all. Now let's say you sell call options. Let's say you sell call options. Well then, now you're on the other side of the trade. So you're selling somebody else a call option. They have the right to buy the stock from you. Why are you going to sell calls? Well, one of the reasons is to generate income. Because when you sell calls, somebody's paying you the premium. So anytime they say, how can you generate income, you're going to look to sell an option. We'll talk about the strategies a little bit later. What's the risk, though? Well, if you sell somebody a May 30 call, they can call away the stock. So let's say the stock is worth 50. Are they going to want to call away the stock from you for 30? Absolutely. So they're going to come in the room, they're going to say, hey, pal, I'm calling away the stock. So what do you have to do? You have to deliver to them at 30. You got to sell it to them at 30. And where are you going to get the stock? Well, unfortunately, you're going to have to pay $50 for it in the market. If the stock goes up to 80, are they going to want to call it away from you for 30? Absolutely. So you got to go into the market, buy it for 80, and deliver it for 30. You got a problem in both of those cases. But by the way, in both of those cases, the option is in the money. So again, in this case, in the money is not good. In this case, in the money means that you are losing money. It means you are losing. But it's still exercise. It's still in the money. Now that being said, what if you anticipated that the person might call it away? What if you saw it coming? So what if you already purchased the stock beforehand? That way you didn't have to worry about what it was worth in the market. Well, that's called a covered call. A covered call. So you're selling a call. You can see we're selling a call option, but we already own the stock. That way if somebody comes in the room, we have it in our back pocket. If somebody calls it away, we don't have to worry about buying it for $100 in the market. As an example, let's say the stock goes up to $50 immediately. Stock immediately goes up to 50, and I know we're running a little bit short on time. I just want to make sure we can get through all the examples. I'll probably be done in about 6 or 7 minutes. Let's say the stock goes up to 50. Well, they're going to come in and call it away for 30. They come in, they say, hey, pal, I'm calling it away. Well, what did we pay for the stock? We paid $26. So we actually make $4 a share, and we made our $7 premium. So overall, we make $11. Let's say the option expires in May, and then the stock goes up to 50. Well, if that happens, we get all the upside, right? Because the option went away, so we get all the upside on the stock. We get $24 on the stock, and we collected our premium. Remember, whenever you sell an option, you collect the premium. So this is great. And even if the stock goes down, let's say it goes down to 15. Well, on the stock, you lose 11, but that's offset by your premium. So you don't lose as much as you would have. So that's why you're kind of neutral here. Because, if the stock goes up, you make a little. If the stock kind of flatlines in the second scenario and then long-term goes up, you make a lot. That's why short-term, you're kind of neutral. And even if the stock goes down, you know what? You don't lose as much as you could have. You don't lose as much as you could have because, again, you collected the premium that offsets some of your risk. How do you find the break even on a covered call? Same thing, you plug in your answer choices. I'm not going to go through it here in the interest of time, but what are your answer choices? Well, you take 26 plus 7, 26 minus 7, 30 plus 7, 30 minus 7. I guarantee those will be your answer choices. And whichever one gives you a profit or loss of exactly 0, that's the one you're looking for. Okay, what you'd find here is that we initially collected a $7 premium, which kind of gives us a 7-point buffer. So our break even here, we can lose up to $7 on the stock. So our break even would be at 19. Because if the stock falls to 19, that would wipe out our $7 premium that we collected. How about if you buy a put option? Let's say you buy a put option. Well, when you buy a put, you have the right to sell the stock. So when are put options? What do you want to happen? When do you want to sell stock for 30? Would you want to sell stock for 30 if it's worth 50? Absolutely not. What if the stock was worth 10? Would you want to sell for 30? Sure you would. So what's your attitude when you buy puts? You're bearish. You want the stock to fall. So if I were to ask you the maximum gain, well, you'll achieve the max gain if the stock falls. So if it goes all the way to 0, it's going to be in the money. So when are put options in the money? Put options are in the money when the market value is below the strike price. Puts are in the money. They're exercised when the market value is below the strike price. So if the stock falls, we'll be able to put the stock for 30. We can sell for 30 even though it's worth nothing. So we make $30 minus our $4 premium. So we make $26 a share. Let's say the stock goes up. Your max loss, well, let's say it goes up all the way to 100. If it goes up all the way to 100, are you going to want to put it for 30? You going to want to sell for 30? Absolutely not. It's going to expire. You just lose your premium. And the break even, again, you'll plug in your answer choices, but you paid a $4 premium. So to break even here, you got to make $4. And how would that happen? Well, if the stock went down to 26, you'd be able to sell it for 30, buy it back for 26, so you'd break even. And just one example about how this strategy works for a more complex position. So here you have a spread. We have two call options. Whenever you have two calls or two puts together, that's called a spread. And again, the point of this example is not to teach you spreads, because that requires more than what we have time for. The point here is to show you that this strategy for single positions that I've gone through for the last 20 or 25 minutes works for spreads. So this is a bull spread. But if I were to ask you the maximum gain, what do? You plug in 100, just like we've been doing the last 25 minutes. And you evaluate each position. First position, second position, premium. So at the first position, we have the right to buy it for 35. You want to buy it for 35 if it's worth 100? Sure you do. So for the first position, you're making $65. Second position, it's also in the money. See, the market value is above the strike. But remember, it's in the money, but we sold it. And that was the example I went through a minute ago, which means we're on the wrong side of the trade. Remember, the person comes in and says, hey, pal, I'm calling it away for 45. So we got to get it for 100, give it up for 45. So they're both in the money. The difference is, on the first call, we're going to profit big time. On the second call option, we're going to lose big time because we're on the wrong side of the trade. So again, nice organized approach, right? First position, second position, premium. So max gain is $8 a share. Again, same song and dance I talked about with single positions, and it works just as well. Max loss, well, if you're bullish, you want it to go up. When do you lose? If the thing goes all the way to 0. And if it goes all the way to 0, check this out. Forget about the buy and the sell. You can cover up the buy and the sell. You can forget about those. Market value is below the strike for both of these call options, right? Doesn't matter if you're buying or selling. Remember, it is a fact, going back to that fundamental point, it is a fact that if the market value is below the strike price, the option is out of the money. So they both expire, and you lose your premium. Again, just knowing in the money, out of the money, and that organized technical approach. And your break even, well, it's based on your net premium of -2 here. You see, we paid $4 for the first one because we bought it. We collected $2 for the second one because we sold it, so net we paid $2. So we paid $2 here. We'd have to earn $2, and again, on the test, you'll just plug in your answer choices. You'd end up with a break even of $37. End up with a break even of 37 again. But all the break evens, you might have 6, 7, 8 break even questions on the test. Don't do anything fancy. Don't give yourself too much credit. I mean, trying to memorize the break even here is the net premium plus the strike price of the lower plus the lower strike price. That's a big mouthful for one debit call spread. Then you got to memorize something else for a credit call and a debit put and a credit put spread. So just plug in your answer choices. Nothing fancy, but again, no style points. They don't grade your work. So that's pretty much it for the prepared material that I have. I know I went over by about 5 or 7 minutes. I apologize for that. I had to pick up the pace a little bit at the end. The purpose of this lecture, again, is to show you, I think, what is the value of the instruction for the class. Specifically, to be honest, I think you'll find a lot of value in our instruction. I think many of you already have our study material, so hopefully you're taking advantage of our classes either live with me or live with one of my colleagues or online with me or one of my colleagues. Again, we have all of our lectures. We have live, we have virtual classes, we have on-demand lectures. So either way, I would encourage you. I think you see just with 90 minutes, hopefully I've helped clarify some of the major concepts and some of the difficult concepts as it relates to retirement plans, the options, and the equity trading. At this point, I know some of you might have to bounce. Before you do, I'll just ask one thing. I will take questions, but I'll ask one thing. I'm going to send you out a survey after class. I would greatly appreciate it if you'd take a couple minutes, fill out that survey, let me know what you thought about this review class. You'll get that from my office tomorrow. That being said, does anybody have any questions about specific content, about study strategy? You can just chat the question, and I'll respond to I'll repeat the question and then respond for everybody's benefit. I'll just give you, 20 or 30 more seconds to come up with any questions you have. Otherwise, we will call it a night. And I'll let you all get home to friends and family. Okay. Well, great. Thank you very much, everyone. I hope you found this helpful. Again, I would appreciate if you fill out that survey when you receive it. If you have any questions, don't hesitate to get in touch. And, best of luck on your exams. Thanks very much. Have a great night.